Good morning. I'm Manqing Sun from Scope Fund Analysis. Welcome to Scope's Portfolio Manager Conference, where our guest speaker and I take you inside the investment strategies that are shaping the rapidly evolving capital market landscape. Today, we're diving into the insured credit market, an area with unique potential for yield, security, and sustainability, with none other than George Nijborg, Head of Insured Strategies at Aegon Asset Management. Good morning, George. Welcome.
Good morning. Thank you for having me.
So before we begin, I'd like to remind you with few logistics. A webinar replay will be available shortly after the live event. You could watch the replay on our Scope Explorer. And also, we'd love getting your questions, so keep them coming throughout. We'll do our best to answer as many as we can. So to start, George, can you tell us a bit about yourself, your team, and Aegon's role in pioneering the insured credit market?
Yeah, sure. So my name is George Nijborg. I've been at Aegon Asset Management for several years now. My background is in debt capital markets, having worked at Morgan Stanley, Citi, and Goldman Sachs, doing the distribution and syndication of private market and public market transactions. Now I'm at Aegon Asset Management, which is a 300 billion euro plus asset manager. Also fixed income, so alternative fixed income or private debt is a key pillar for the firm. And with about 80 billion euros of AUM, I'd say one of the larger players in this space in Europe. We set up insured credit several years ago, and to give you a background, it's a product which we have been doing in the broader sense, where we have been active for several decades in the government guaranteed space. So that's using guarantees from governments or government-related entities, such as export credit agencies, and that's something that we've been doing for many years. At the same time, we have been familiar with the bank world in terms of the banks using the credit insurance product, insuring their loan book, and we decided to marry these two things together and create insured credit. And just like with other alternative fixed income strategies, these have initially been part of a bank book, banks doing it for their own balance sheet. But then over some period of time, asset managers have taken inspiration of these strategies and developed them to make them more accessible for institutional investors. So that is exactly what we've been doing with insured credit, and I would say we are a very early mover in creating such a product for institutional clients. In terms of the team, so besides myself, we have a dedicated insured strategies team, including two London-based insurance experts, which makes us quite unique in the space, I would say.
Thank you, George. So now for those new to the concept, what exactly is insured credit? Could you explain how the dual recourse mechanism works and why this is essential for our investors?
Yeah, so insured credit gives a unique access, I would say, to a portfolio of private placements of exclusively single A and double A rated global well-diversified insurance companies. So you have to think about insurance company names like AXA, Chubb, Swiss Re. And all of these insurance company exposures are backed by some form of collateral. The investment universe for insured credit is approximately 60 odd insurance companies to which a client will be exposed to. And the underlying collateral is in the form of loans and bonds, which is selected by Aegon Asset Management and 100% credit insured by the single A and double A rated insurance companies. That means that an investor's ultimate exposure is against the insurance companies that I mentioned. So in terms of insured credit, we can compare it to other asset classes out there. So you can compare it to NHG guaranteed mortgages in the Netherlands, covered bonds issued by banks. We have some sort of collateral pool and the bank. ECA or government guaranteed transactions, where again you have an underlying loan or bond which is guaranteed by a government or government related entity, or for example a CDS basis trade. Now what is very essential in this product for clients is the double recourse nature in insured credit. So in terms of the principal and interest payments that the client receives, in first instance those are paid by the underlying collateral. However, in the event that that underlying collateral cannot pay out for any reason, then the investor has recourse to the single A, double A rated insurance companies for any missed principal and interest payments. That means you have recourse to the underlying collateral and the insurance company, which means that if one falls over, you always have the other to receive principal and interest payments. Ultimately, from a risk perspective, a loss materializes if both the underlying collateral and the insurance companies fall over at the same time. So what we can consider is that insured credit is a relatively low risk credit product out there.
Let's also talk about returns. How does insured credit offer attractive yields for investors, especially when compared to liquid credits or insurance company bonds?
Sure. Insured credits typically offers a yield of swaps plus 225 basis points, so 2.25% over swaps. If you compare that firstly to investment grade liquid credits, you will notice in the current markets that is a pickup of in excess of 140 basis points. If you look a little bit more closer to the comparable universe, so insurance company bonds, which you can buy in the capital markets, these are yielding swaps plus, let's say, 70 odd basis points, and therefore you can replace your exposure to these insurance companies in bond format and purchase insured credits transactions with the ultimate same risk, but then get a pickup of an excess of 150 basis points. I think what is also important to notice is that in insured credits, we only consider transactions which are rated single A and double A. Whereas, of course, if you participate in the investment grade liquid credit markets, you get exposure to single A, double A exposures, but also triple B exposures. So the pickup that I'm referring to is not adjusted for the credits rating uptick.
So that's fascinating. And how might insured credit complement or even replace traditional investment grade corporate credit within the institutional portfolios? With what specific needs does it address?
Well, as I mentioned before, clients see insured credit as being effectively a portfolio of exclusively single A, double A rated insurance companies. And that means that you can consider this as being replacing or complementing existing investment grade corporate credit or private placement exposures. However, in our view, there are several additional benefits of having insured credit sitting alongside or replacing these two asset classes. Firstly, is what I referred to the attractive yield, so the relative value versus the other asset classes. Secondly, is the enablement of organic capital creation and improving the return on capital for clients, for which that is important. So if you consider Solvency II standard model treatment of insured credit, you will see that the gross capital charges are typically between 2 and 6%, which should be relatively attractive from a return on capital perspective. Thirdly is the fact that I mentioned that is a low risk product. Firstly, because of the credit quality of the insurance companies involved, or single A, double A rated insurance company. And secondly, because of the double recourse nature, where you have recourse to the underlying collateral and then ultimately to the insurance company. And last, what you would expect from a asset class like this, it provides clients a stable income stream.
So great insight. Let's shift gears and take a closer look at the fund specs. Could you walk us through the types of underlying collateral used in this strategy? How does the team ensure the quality and sustainability of these assets?
Sure. In terms of the underlyings that can be insured by the single A, double A rated insurance companies, we typically split them in three groups. Firstly, there are emerging market sovereign loans and bonds. So those are like I said, a loan to a particular sovereign. That sovereign will use the proceeds to fund underlying projects. So, for example, the building of a hospital or water sanitation project. That's the first category. The second category is developed market corporate loans and bonds, which also can be insured. And the third is structured finance. So these are typically mezz tranches within structured finance transactions across CLOs, across across SRT type transactions, which can also be insured. Therefore, we have a lot of flexibility in a very large investment universe to consider what types of underlying collateral we are comfortable with in getting fully insured. Now, when we look at the review or the screening we do on the underlying collateral, I would highlight that although our clients benefit from 100% protection by means of the credit insurance coverage provided by those single A, double A rated insurance company, we at Aegon Asset Management still do an extensive screening of the collateral. And this is done in various forms. Firstly, we look at the credit quality of the underlying collateral. How sustainable is the credit quality? Secondly, we look at the CDD aspects, the reputational aspects of looking at a particular form of underlying collateral. Thirdly, we look at of course, the legal documentation part. And lastly, we look at any ESG risks in the underlying collateral and potentially any linkage we can do to UN SDGs. So once we've scanned the underlying collateral, we approve it, and then we look for insurance coverage, and then we put the transaction together. Now, not all transactions, of course, go live. Our deal acceptance rate is around 10%, I would say. There's two main reasons why we decline transactions. On the one hand, because we turn it down because we don't like the underlying collateral for some form. Typically, that's either the credit quality or the reputational risk or the ESG risks that we say the underlying collateral doesn't work for our clients. Or the other reason why we decline particular transactions is because the insurance companies that are insuring the underlying collateral do not work for us from, again, the same reasons from a credit standpoint or some other standpoint which we decided to turn down.
But thanks for clarifying. Now, regarding portfolio management, could you share a snapshot of the current portfolio, including its duration, credit quality, and maybe a few recent buy or sell decisions, if we may? And also, what primary risks are involved in this strategy?
Yeah, sure. So first of all, let's tackle the credit quality. I think I've highlighted it a lot, but worth mentioning again that the credit quality is all single A, double A rated exposures. These credit exposures mirror the insurance companies that we use in our portfolios, and all of them are single A, double A rated at inception. If you look at a typical portfolio, you will see a split approximately of 60% exposure to double A rated insurance companies and 40% to single A rated insurance companies. Thus meaning that your weighted average credit quality is in the A+ region. Secondly, in terms of duration, you will typically see a duration anything between 2.5 to 5 years. I give a relatively wide range because it depends on the mix of fixed rate and floating rate deals in any given portfolio. So for larger clients, we can create dedicated portfolios which are 100% fixed rate all the way to 100% floating rate, depending on our clients' preferences. So that's why the duration is between 2.5 and 5 years. Then in terms of the illiquidity premium or the, let's say, pickup versus the investment grade universe out there, historically we've achieved in excess of 130 basis points pickup versus equivalently rated liquid investment grade credit. So, that's the kind of pickup that can be achievable in these portfolios. I would say clients should be aware that these are buy and hold transactions. These are not positions that we are actively looking to sell. So I think that works well for more institutional clients in that sense. Now, in terms of the risks, I think that was one of your questions. I think something I thought about beforehand, like what are the typical questions that may come up from a client when reviewing an insured credit portfolio? I would say the first question that we get is, well, what is the track record of this type of product? The answer there is relatively straightforward because credit insurance as a product is not something new. It's actually been used for many decades by banks in very large volumes, billions a year that get insured via this product by banks. And there's data that has been compiled by the insurance community which shows that since 2007, about $5.2 billion of claims have been paid out under this type of insurance policy. So I would say that the product itself has been extensively tried and tested. Secondly, the question that there can arise is, well, am I fully protected on the collateral exposure? Now, the answer there is yes. The credit insurance policy is structured in a way where 100% of all future contractually agreed principal and interest payments are insured by the insurance company, so you are fully protected on the underlying collateral. Now, the third one is around the exposures, the ultimate credit exposures to insurance companies. Why would I invest in a portfolio of insurance company exposures? I would say there it's also relatively straightforward, because ultimately you are looking at a exposure to high-rated global diversified insurance companies. So these are well-known household names a lot of the time. I mentioned a few before: AXA, Swiss Re, Chubb, very big, large, well-diversified insurance companies. And if you look historically at the credit rating as a very kind of public available tool, which can be used to track the credit quality of an insurance company over a longer period of time, you'll see that a lot of the insurance companies out there have had such stable ratings over many, many years to, for example, a pre-global financial crisis. And there are plenty of examples of insurance companies which have had the same rating since pre-global financial crisis all until up until now. And that rating hasn't changed, gone up or down. So it's nicely stable, which is something that I think fixed income investors like to see. Insurance companies also, I think, worthwhile to say that they've evolved through the years, have become more heavily regulated institutions, and have become significantly well capitalized. And lastly, I think the final point to note is that the insured credit portfolio, the exposures that can be given there, provides a nice diversification tool for clients. So not only is it a very unique proposition in being exposed to insurance companies, but also you can get exposures to insurance companies that you wouldn't be able to get exposure to via the traditional capital markets. So that's because an insurance company might not have any bonds outstanding that you can purchase, and therefore insured credit is a unique way to get exposure to a particular insurance company.
That's very thorough. I think you've mentioned the non-payment insurance before. Could you maybe share a little more details? Could you elaborate on how the NPI operates within this structure and the benefit it brings to the portfolio?
Yeah, so the exact name indeed of the insurance policies we use are called non-payment insurance policies. Now, the name says a little bit of what it does. It covers you for non-payment of an underlying borrower. So non-payment insurance policies are typically used as a risk mitigation tool to transfer the credit risk of an underlying borrower to an insurance company in exchange for a premium payment. The non-payment insurance policies, or NPI policies, protect against the failure, refusal, or inability of an obligor to pay any amount for any reason. So it's a very comprehensive insurance policy. And then we make sure, obviously, that the policies cover 100% of principal and interest due from an underlying collateral, which ultimately gives full recourse, full ultimate credit exposure to the insurance companies. So when we get transactions rated by external rating agencies, the rating agencies always look through to the rating of the insurance company as the underlying collateral is fully covered by their insurance policy. So I would say that the non-payment insurance policies are very similar to what people would call a financial guarantee, but with limited exclusions. The benefits of non-payment insurance policy can be viewed as threefold. First of all, like I said, it's a proven concept, already tried and tested by the banks for many decades. What we are doing is simply making it more appealing for institutional investors to invest in this type of transaction. Secondly, I believe that this gives a better protection compared to investment grade credits and private placements, because you have the underlying collateral and you have the insurance policy to protect you. So it's a credit enhancement tool. And lastly, I would say the capital treatment that non-payment insurance policies provide is very enhancing from a return on capital and organic capital creation perspective.
Excellent. So with sustainability being top of mind for many investors, especially with European investors, how does this strategy align with ESG goals, particularly in terms of collateral selection and its contribution to the UN SDGs?
Yeah, I think I alluded to before, we already do some form of ESG screening and sustainability screening of the collateral. We do the same on the insurance company exposures that we have in the portfolio. I would first like to say that we treat ESG and sustainability as effectively two separate items. So the ESG screening that we do is the who part. So who are the counterparties involved and what are the ESG risks with regards to that particular counterparty. And simply put, we look at the underlying borrower in the collateral and also the ultimate insurance company exposure. So we do ESG reviews on them. And we only accept counterparties which have an ESG neutral or better risk classification. Then the second aspect is sustainability, and that is the what part in the equation. So what is the money used for? So typically there we will look at the underlying use of proceeds, the projects being financed, and do a sustainability risk assessment on those. So here again, we will only accept use of proceeds where we can say that the sustainability risk classification is neutral or better. However, I would say with regards to sustainability, Insured Credit also offers investors the ability to select underlying collateral with strong social and sustainable characteristics that can satisfy their ESG needs. So there are lots of scalable opportunities out there where the underlying collateral aligns and links to particular UN Sustainable Development Goals, particularly, of course, in the emerging market space. And if you look at the strategy so far, we've been able to link transactions to 10 different SDGs. So I'd like to give some examples of the underlying projects that we financed in the strategy. So for example, intelligent road traffic management systems, as it's called. So that's more a traffic light based technology. Secondly, is the construction of healthcare facilities or additional wings as part of hospitals. Thirdly is water sanitation projects. Fourth is communication infrastructure. So that can be mobile network towers that are being built. And lastly, as an example, is the electrification network expansion or upgrades within emerging markets, which is much needed in those type of countries.
I think we got a question prior to the webinar, actually, from an audience asking, is it only available to institutional clients? Do you have any other vehicles that can provide those access to the portfolio, to the strategy?
Sure. As it's set up at the moment, it's set up for institutional clients. With regards to retail clients, there are options that we're exploring there, whether that's Insured Credit on a standalone basis or as a mix of different products via, for example, an LTIF type structure that is very much on the cards, I would say. So it's a work in progress, and we would very much like to get in touch with any counterparty which thinks that this could be interesting for their retail client base.
Indeed. So finally, looking at the current environment, why do you think now it is an opportune time for institutional investors to allocate to insured credit?
Yeah, I think it's interpretation of how markets are at the moment. If you consider that markets are a little bit more volatile now, and also in the coming weeks because of to take a very topical point, the US elections, then you can consider Insured Credit as offering a low risk product which counters any form of volatility. The product offers stable income streams with very limited volatility. So it's a nice way of still being invested in these type of markets. Secondly, if you consider what's happened over the last months, years, and the outlook going forward, of course, there's higher risk now to more stagnant growth in the more developed market economies. Default rates maybe are creeping up across the globe. So, yeah, I mentioned Insured Credit, a relatively low risk product which protects you on downside risk, be it the insurance policy protection. So that is a strategy which I think, if you are more geared to more defensive portfolio, that could be nicely added to that without giving up relative value and return on capital and all those important points as well. And lastly, of course, if you are looking at investment grades, illiquids that offer a nice relative value and return on capital, insured credit is typically high on the list of our clients as a way to invest.
A big thanks to you, George, for sharing your insights into Aegon's insured credit strategy with us today. As we've discussed, insured credit offers institutional investors access to a portfolio of highly rated, diversified insurance companies, delivering attractive yields, low credit risk, and the potential to complement traditional investment grade exposure. To our audience, we hope you find this session insightful and leave inspired. Thank you for joining us. Have a wonderful day. Thanks, George.
Thank you. Thank you.
Bye.